Bentornati
Welcome
amiche e
back,
amici su
friends, to
Traders
Trader
Cult.
Cult. As promised, we are here with a new video, new content, extremely useful for anyone approaching trading. And of course, we are talking about PATs, which are those figures or symbols that appear on financial charts and indicate the continuation or reversal of a trend. They are widely used, especially by those who apply price action. Of course, I suggest, as always, to try these practices on your demo accounts or on your practice account because you won't be taking any financial risks, and you can gain experience as many times as you want. Before moving on to a real account, I suggest you try again to learn these figures because there are truly many of them. In the description, you'll find useful links to open a demo account, a practice account, and also the link to our Telegram channel. Subscribe because there are many contents there, and above all, there will be continuous surprises for our subscribers, for our loyal followers. Remember that trading is a high-risk job, so don't be hasty and always try to grow from an educational perspective. But let's not waste any more time. Let's start right away with today's topic. Candlestick patterns are specific graphical representations where candles on a chart form distinct figures. These patterns serve as indicators, signaling potential trend continuation or reversal. It is important to note that, like any indicator, candlestick patterns should be utilized in conjunction with other indicators. Bearish 3. The bearish 3 is a continuation bearish pattern comprising two long bearish candles with a series of smaller bodied candles in the middle, typically staying within the range set by the first bearish candle. Bullish 3. Bullish 3 is a bullish continuation pattern consisting of a lengthy bullish candle followed by three bearish candles and another bullish one. Generally, the three smaller candles fall within the price range of the bullish candle. Falling and rising 3. Uptrend. The first and fifth candles are bullish, aligning with the trend, and must also be longer than the other three candles. The second, third, and fourth candles are bearish, remaining within the real body of the first candle, with lows at the first candle's open and highs lower than the first candle's close. The close of the fifth candle must be higher than the close of the first candle. Downtrend. The first and fifth candles are bearish and longer than the other three candles. The second, third, and fourth candles are bullish, remaining within the real body of the first candle, with lows below the first candle's open and highs greater than the first candle's close. The close of the fifth candle must be lower than the close of the first candle. In neckline. In the in neckline, the closure matches the bearish candle's closure. Ledge. The ledge is a consolidation pattern representing a micro-congestion, formed by 4 to 8 candles reaching the same minimum and maximum, possibly indicating a continuation of the bullish movement, after a rise in prices or, vice versa, in a bearish trend. On neckline. The on neckline pattern is a continuation bearish pattern consisting of two candles. The first, bearish, is followed by a small bullish candle with a closing price very close to the minimum of the first candle. Separating lines. In the uptrend, it consists of a bearish candle followed by a bullish candle with the same opening price as the first. In the downtrend, it consists of a bullish candle followed by a bearish candle that opens at the same price as the first. Side-by-side white lines. Uptrend. The first candle is bullish, in line with the bullish trend. Then there is a gap up between the first and second candle. The second and third candles are bullish. They have real body similar in length. Moreover, they have the open at the same level more or less, but it is superior to the real body of the first candle. Downtrend. The first candle is bearish, with a gap down to the second candle. The second and third candles are bearish, with similar real body lengths, and opens at approximately the same level, closing lower than the first candle's real body. 3 white soldiers. 3 white soldiers is a bullish continuation pattern with 3 consecutive bullish candles closing above the previous candle's closing prices, commonly used, and can signal a reversal if preceded by an opposite trend phase. Bristing line. Bristing line has the closure within the range of the previous candle, not exceeding the average price, distinguishing it from a reversal signal like the piercing line. Inversion patterns. Dark cloud cover. Dark cloud cover is an inversion pattern observed during uptrends. It comprises a prolonged bullish candle followed by a bearish one. Typically, the second candle opens at a higher price than the maximum reached by the first, closing around 50% of the bullish candle. Doji star. The doji star pattern signals a reversal on the chart, confirmed by the subsequent candle. It features a doji candle, forming above or below the preceding candle. Whether bullish or bearish, a bullish reversal is confirmed if the candle following the doji is of a bullish nature. Engulfing. Engulfing patterns are robust reversal signals, either bullish or bearish. A bullish engulfing pattern involves a small bearish candle followed immediately by a lengthy bullish candle that engulfs the price range of the previous candle. Conversely, the bearish pattern comprises a long bearish candle followed by a small bullish one within the price range of the second candle. Evening doji star. The evening doji star is a potent reversal signal with 3 candles, a very long bullish first candle, a doji second candle, and a bearish third candle, closing around 50% of the first's price range. Evening star. The evening star, often marking the end of a trend, includes 3 candles, a very long bullish first candle, a shorter-bodied bullish second candle above the first's price range, and a bearish third candle closing around 50% of the first's price range. Gravestone doji. Gravestone doji, an inversion pattern, features a doji where the opening and closing prices represent the candle's minimum. A longer shadow strengthens the bearish signal. Hammer. The hammer, a bullish reversal pattern in downtrends, is characterized by a bullish candle with a small body and a long lower shadow, with a typically small or absent upper shadow. Hanging man. The hanging man, a bearish reversal pattern near the upper end of the trading range, is identified by a small-bodied candle with a lower shade twice the length of the body, and a small or non-existent upper shade. Harami. Harami, interpreted as either a bullish or bearish pattern, is bearish when following an uptrend. It involves a long bullish candle, succeeded by a bearish candle with a very small body, contained within the previous candle. Bullish harami follows a downtrend, featuring a long bearish candle, followed by a smaller bullish one within the first's range. Bearish harami cross. Bearish harami cross signals a possible reversal, consisting of a doji within the range of a long bullish candle. Bullish harami cross. Bullish harami cross, an inversion pattern, has a long bearish candle followed by a doji within the first candle's price range. Morning doji star. The morning doji star, an inversion pattern, involves 3 candles, a long bearish first candle, a doji second candle below the first's range, and a bullish third candle closing around 50% of the body. Morning star. The morning star, typically found at trend ends, consists of 3 candles, a long bearish first candle, a small-bodied second candle below the first's range, and a bullish third candle closing around 50% of the first's body. Piercing line. Piercing line, an inversion pattern, comprises two candles, a bearish candle followed by a bullish one opening at the lowest price of the first but closing over half of it. Reverse hammer. Reverse hammer, an inversion pattern in downtrends, is the opposite of the hammer. It features a bearish candle with a small body and a pronounced upper shadow compared to the absence of the lower shadow. Three black crows. Three black crows is a bearish reversal pattern with three long bearish candles, each closing below the previous candle's minimum. It can also signal a reversal if preceded by an opposite trend phase. Three white soldiers. Three white soldiers, a bullish continuation pattern, consists of three consecutive bullish candles closing above the previous candle's closing prices. It can also indicate a reversal if preceded by an opposite trend phase. Tweezers. Tweezers are reversal patterns, with two candles that can form after an uptrend or downtrend, suggesting an imminent reversal. Tweezer top features two candles with similar highs, while tweezer bottom generally includes two candles with the same lower price level, irrespective of size and color. As you have seen, there are really many figures. There are many graphic signs that we need to learn and assimilate to help us better understand the price movements of what we will then deal with, whether they are indices, stocks, commodities, or forex. It can also be used in binary options, but we will make separate and different videos for this topic. I invite you in the comments to ask your questions, suggest new insights if there is a topic that is dear to you, and you would like to see a video about it. Let me know without any problems. But above all, I invite you to subscribe to the channel and activate notifications. Share the video with your friends, and we'll see you in the next video. Thank you very much, everyone. Goodbye.